This week, we ask a simple question with big implications. Is housing wealth real or imaginary? That question was raised in a recent column that, at first glance, challenges some widely accepted assumptions, but beneath the headline is a more nuanced argument about the difference between perceived wealth and real, tangible wealth. We'll get into all of that right after this brief message from our sponsor.
Liberty Reverse wants to help you grow your reverse mortgage business with our proprietary Equity IQ product suite. Equity IQ gives your borrowers access to more funds, lowers their upfront costs, and expands eligibility for home purchases. Learn more at partners.libertyreversemortgage.com today. This ad is intended for mortgage professionals only and is not a consumer solicitation. PHH Mortgage, doing business as Liberty Reverse Mortgage, is an equal housing lender. NMLS number 2726.
Welcome back and thank you for joining us. Household net worth in the United States sits near record highs, largely driven by rising home values. However, a recent column from George Mason University's Mercatus Center entitled "We Are Not as Wealthy as We Thought We Were, Elevated American Household Net Worth Reflects Poverty, Not Wealth." It's quite a title. It argues that home values don't necessarily reflect true economic prosperity or an improved standard of living, and in some cases, even poverty. The author's core argument is straightforward but often misunderstood. Rising housing prices or values boost household balance sheets, but that doesn't automatically mean that these households are meaningfully wealthier in ways that actually improve daily life, consumption, or long-term security. Much of what we call housing wealth is the result of scarcity and higher prices for shelter, not the production of more housing or better housing relative to one's income. To understand this, it helps to look at long-term price trends. From 1980 to 2025, the Consumer Price Index, the broad measure of inflation across the U.S. economy, increased by roughly 290 to 305%. In simple terms, something that cost $100 in 1980 costs close to $390 today. That's inflation doing what inflation does over 4.5 decades. Now, compare that to housing. Inflation-adjusted home prices over the same period rose by roughly 320 to 330%. That means that housing prices didn't just rise because of everything else, but they slightly outpaced overall inflation even after adjusting for it. And that's an important distinction. It tells us that the growth in housing values is not merely a reflection of general price increases, but of housing becoming more expensive relative to other goods and services. The Mercatus column makes that case that the divergence is not a sign of national prosperity. Rather, it reflects long-term underbuilding, zoning constraints, and a chronic lack of housing supply. Today, Americans are paying more for access to shelter, but are not necessarily seeing a meaningful improvement in their standard of living. And that's where the idea of wealth becomes a bit slippery. Housing wealth, as recorded in household net worth data, is largely illiquid. It exists on paper until it's separated from the home through a transaction. Now, until that happens, it cannot be used to pay bills, fund retirement, or absorb economic shocks. In that sense, housing wealth is merely a number until it can be accessed. And there are only a few ways that equity does become real money. A homeowner can sell the home. They can refinance into a home equity loan with the bank or broker. They can open a HELOC, or for older homeowners, they can access their equity through a HECM reverse mortgage or a proprietary reverse mortgage, and now non-reverse equity loans, which, by the way, are being available from several notable lenders in the reverse mortgage space. Until one of those actions occurs, rising home values do not automatically translate into higher standards or tangible wealth. And there's another point. The column emphasizes something that many housing analysts acknowledge, but policymakers generally ignore, and it's this. Rising housing wealth, it's regressive. Let me explain. Higher prices benefit existing homeowners while imposing higher costs on renters and first-time buyers. For younger households, higher home values function more like a tax than a benefit. Rent rises faster than income, down payments grow further out of reach today, and real purchasing power is eroding. But There is often a twist, and with rising home prices, it can be regressive, of course, at a societal level, but they are materially beneficial for the older homeowner. For many retirees, accumulated home equity now rivals or even exceeds their retirement savings. In an era where defined benefit pensions are rare and 401k accounts are often underfunded, home equity has quietly become the largest reservoir of potential retirement capital. In essence, the columnist is saying that the problem is mistaking increasing home prices for broad-based economic strength when it's not. Housing wealth can simultaneously reflect scarcity and stress in the broader economy, while also serving as a crucial financial resource for older households who know how to access it responsibly. And that distinction also matters when it comes to policy. When policymakers look at record household net worth and conclude that consumers are resilient and that rates can stay higher for longer, or that affordability pressures are overstated, they're often misreading the data, and that has real-life impacts. So is housing wealth real or imaginary? The answer depends on how it's used and how it's interpreted. It's imaginary when it's cited as evidence that Americans are generally wealthier due to higher home values, especially in the last 4 years. However, it's very real when it is converted into usable funds through a sale, refinance, HELOC, reverse mortgage, or the latest generation of equity loans. Housing wealth may not feel real until its benefits have actually been unlocked, something that house-rich and cash-poor and even affluent homeowners know all too well. What are your thoughts? You can leave those in the comment section below. And if you'd be so kind as to share this week's video on your LinkedIn network, we thank you for that. We do have a YouTube channel. Be sure to subscribe. That way you never miss any of our latest content. And if you want to catch up on your reverse mortgage news and do it in an easy and hassle-free way, we've got you covered with our weekly podcast, Heckham World Weekly. We have both an audio and a video edition. Listeners can listen and subscribe on Apple Music and Spotify. Thanks so much for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find, yes, you know it, right here at Heckham World. Have a great week.